Hi, this is Sue Derby at Shorewest Realtors with this week's edition of Tuesday's 2 Cents Worth. Today I'm talking with Josh Bucio at Waterstone Mortgage. Josh works with all sorts of loan products, including doctor loans, dentist loans, teacher loans, portfolio loans, and of course conventional mortgages. But with the rising interest rates, I thought this would be a good time to talk to Josh about ARMs. Thanks for meeting with me today, Josh.
Thanks, Sue. So the ARM products are very popular today because of the rise in interest rates. So the ARM is popular because it helps give people a lower interest rate, which will help lower their payment. So the advantage is to try to make the payment and the home more affordable for a lot of people. And the traditional ARM products typically are 5-year, 7-year, and 10-year. And that is the fixed period. That is where the interest rate is fixed. Now, the disadvantages of some of these ARMs is when the fixed period is over, what happens with the rate? Well, it can start to adjust. It may go up or it may go down. It just depends on the future markets and indexes that are used. But the period, which is fixed, is quite a long time. 5, even 7 years is quite a long time from now. And a lot of people think the rates are going to come down, which means they're going to refinance out of it. So they'll take an ARM to help them lower their payment and then refinance in the next year or two, or however long it takes for the rates to come back down, and then refinance into a traditional 30-year fixed rate. They're not for everyone, but most people will probably look at them because of just the rise in rates have increased payments so much, and it's just there to help it be more affordable when it comes to buying a house.
So what is usually the rate difference between doing an ARM and doing a conventional mortgage?
Yeah, good question. I've seen a whole percentage point difference, if not a little more, maybe 1.25% difference. So that can change someone's payment $150 easily. So.
Well, that's a big chunk then.
Yeah.
So are there any other disadvantages to doing an ARM?
Myth. Let's talk about a myth that people think is a disadvantage is that ARM is a balloon. So when that fixed period is over, let's say it's a 5-year, in 5 years the mortgage is due. No, that's a balloon payment. These are traditional ARMs. So when the fixed period is over, the rate will start to adjust up or down, and there's caps, there's maximums to how much that rate can adjust. But you can continue to make the payment month after month, year after year. You don't have to change it. You're just subject to the higher rate, which is a higher payment.
So is it amortized over a 30-year or a 15-year, just like a conventional mortgage would be?
Yeah, traditionally it's over a 30-year to keep the payment lower.
Oh. Yeah. Well, that sounds like that could be a really good option for some people. Thanks, Josh.
I think it's very good because most people are actually doing it today.
All right.
Yep.
So Travis and I want to be sure that you're aware of all the different ways that you might be able to purchase. And we're happy to put you in touch with a lender like Josh that can offer you options to fit your specific needs. Thank you so much for your time today, Josh. I'm confident that our clients are going to be in good hands when they come to you. Thanks for tuning in to Tuesday's 2 Cents Worth. This is Sue Derby at Shorewest Realtors, your local realtor ready to work hard for you. If you find this information helpful, please share it with your friends and family.